and welcome to the chapter number 15, which deal with the revenue recognition issues. So while we are recognizing our revenue, we have to face some of the issues when different conditions come up. So these are called the issues in the revenue recognition. We will discuss that throughout the chapter. This standard deal with IFRS 15. So 1.5 say that, hey, we need to recognize our revenue if this condition is fulfilled. So let's dig into the chapter. So these are the few objectives of the lecture. We try to understand when and how we can measure the revenue, what is the rationale behind it. So there is a five-step approach, and how we can measure the revenue when the revenue is variable, like it changes from one condition to another. What is the definition of control in this chapter? Control means if the asset is transferred from the seller to the buyer, the control should transfer with it, or the risk or reward should be transferred with it. So we will define what are the different controls. We try to understand the existence of the particular conditions relating to the sale. We talk about the call option. We will try to talk about the put option. If the put option is there, call option is there. It's more like a financial instrument, which we'll discuss in the later chapters or later videos. So we see when and how we can recognize our revenue. And if there's a condition, if you sell the asset with the condition that you will buy back or it can be refunded, then this kind of an overtime condition, how we can deal with the revenue recognition. So first is the definition. I hope you are already familiar with the definition of the income. Income is an increase in the assets or decrease in the liability. So they are just taking the definition from the balance sheet. And this is a particular traditional definition we have so far. Whereas income is divided into two categories. One is revenue and other is gain. Revenue is normally the cash you have generated from your operations is called revenue. Where gain, if you are familiar with this word, I think you get this gain word when you talk about the disposal of assets, gain on disposal of assets, or gain on sale of shares. So any activity which is not the traditional business activity and you get a profit from it is also come under the income. So all these both categories, either revenue or gain, belongs to profit and loss account. So for example, if the company is getting a profit or getting a gain on sale of machinery. So the machine was fully depreciated, they sell in the market, they get some gain. So selling a machine is not the primary business of the company. So we can say, hey, this is a gain. But on the other end, if the company is selling, for example, if the company is a textile business and they are selling t-shirts, selling t-shirts, getting a profit on that or getting an income on that is called revenue. So that's the difference between the revenue and the gain. In the next slide, they give you this detail. You can have a read through. What's the difference between the revenue and the gain, which I just explained now. Now, the revenue is come from a definition by the contract. Like there is a contract between a buyer and seller, and they enter into this agreement. Hey, I will sell you t-shirts and you will give me the money. So this is basically a revenue recognition contract. It can be verbal, it can be written, it can take both of the times, unless until both of the parties understand what is there in the contract. So when we talk about revenue recognition, there is a five-step approach in recognizing a revenue, which is discussed in upcoming slide, but here they just highlighted it. Number one is try to understand the contracts with the identify there is a contract between the customers. Means you as a party has a contract with the customer. So there is a contract, there's offer, and there's agreement, which will constitute legal contract. Then you try to understand or identify a separate performance obligation. For example, you are creating or you are building you are manufacturing 100,000 t-shirts. So it should go bulk by bulk, like 10,000 each bulk. So, on every 10,000, I will get my income. So that will be my contract with my seller. So this is important to understand because it will show you that this is the patch and this is my revenue. You cannot recognize all the revenue on the day first when the contract is being entered. So you have to identify what are the different stages I have to fulfill to complete the contract. So what are the different obligations I need to perform to do this contract? Like I have to deliver 100,000 t-shirts. So this is my full obligation, but what is the different batches I have to do? Then, if I complete my order of 100,000 t-shirts, how much money I will get as a price, transaction money? What will be the money? The money can be cash or it can be in kind. So the transaction price differ. It not always be the cash. So this is so much interesting about this standard that they discuss. Hey, what is the different in-kind cash revenue that can be there instead of cash? Like what other transaction price can be? Then allocate that transaction price to the each obligation which we have identified in step number 2. And step number 3, we try to recognize this revenue as a performance is being satisfied. So once it's done, there will be a tick, then you get your money. And once there is a control which has been transferred from the seller to the buyer, and the obligation has been fulfilled, then you are able to recognize that as a revenue recognition. So revenue recognition follow these 5 steps. This steps hierarchy is just like that. It cannot be changed from one to another. So remember this hierarchy of 5 steps. Next is identify the contract with the customer. So number 1 step was to identify, hey, you enter into a contract, you try to understand what is the revenue, how much money is there. You try to understand what I need to do and different. So this is a step number 1, which is very basic that there is a contract with the customer. Number 2, you need to perform this contract. Performance is another very important issue for the customer to obtain the control of the assets. So, for example, you have identified that I will sell my t-shirts to the customer, but you need to know how much. What is your performance obligation? Your performance obligation say you need 100,000 t-shirts. So this is my performance obligation. It's very simple. It's a very easy example because you have only one performance obligation. However, they need this in batch by batch form. Or maybe you are constructing a building. So once you've done the foundation, that's number 1, performance obligation. Once you created its wall, it's another performance obligation. Once you construct its roof, that's a third performance obligation. So you need to know or identify what is required from this contract. So after you recognize it, the third thing which is very interesting in this chapter is about, hey, what is the transaction price of that contract? It's very much important. This is basically the amount, the price you will get. Again, I say the price can be in kind, the price can be in cash, it depends. And sometimes there's a future contracts or the forward contracts. There's also a price for delivering a certain underlying assets. So these are the few understanding about the transaction price. But there are a few slides on that where they discuss that what is the price can be in the both cases. While determining the transaction price, an entity should consider the effect of the following: whether the transaction price is variable. For example, they ask you, can you produce t-shirts 100,000? And if you exceed with this limit, like you can give us 110 also, we will pay you more money. So 100,000 is the basic. So it's variable, how much you're going to produce. So there's no fixed price. It depends on per t-shirt which you will produce. Then it should contain the estimate of the variable consideration, which we just discussed. Then there's existence of the significant financing component in it. We will discuss that later. Then there's a non-cash consideration involved in it. Then there's a consideration payable to the customer also involved in it, which is altogether you can consider as a transaction price, which is a step 3. Now, what we do with all these non-cash items, the payment of in-kind, we will discuss that with example in upcoming slides. So number 1 is the variable consideration. The variable consideration, for example, you are selling a bike. You sell bike every month, 100 bikes. And you expect some of the bikes have some default which going to return back to you. So if they return back to you, you can expect how much that I can get in the worst case scenario. So you have this expected value concept because your price has been variable. You may return some good bikes, or maybe the customer do not return you the bike. And then there is a most likely amount concept. So we do a one very small example and we see how these two concepts are any different and what is the most important concept that you can use to recognize your revenue. So what they do here, they say you're selling some bikes, and for example, you sell 100 bikes every month for a price of 500,000. So this is a probability that no bike will return will be 15%. One bike will be returned 20%. Two bikes will return 28%. Three bikes will return 22%. Four bikes will return have a 15% probability in a year, in a month. So how, in this case, you're going to recognize the revenue? Because you already sell the bike, the contract has been executed, you take the money already, but you are not sure whether or not I should recognize it because there is a probability of returning the bike. So can you recognize that as a revenue? First question, yes, we can recognize that as a revenue. Second question, what and how are we going to deal with this variable consideration if the bike are being returned? So number one method which we discuss is the expected value method. In the expected value method, what you do, you take the total number of bikes which you sell times the price times the probability. So with every bike that you sell, if one bike is returned, then you will get 98 bikes. If two bikes are returned, then you get 98. If three bikes are returned, you will get 97. If four bikes are returned, you will get 96 bikes. 96 bikes times 500 times the probability of occurring that event. So you some sort of make a weighted average of this expected value. And here the weighted average is 48,990. This is the expected value method. Another is the most likely amount approach, which is very easy. So if you go back to the question, what is the event which is most likely to happen that two bikes will be returned because it has a highest number of probability. So you go with that two bike and you say, hey, not 100, but 98 bikes, I will definitely get. So 98 bikes times 500, the amount is 49,000 US dollar, which is quite near to the weighted average. So these two prices are kind of like take a revenue recognition approach. Just like you have the inventory in your Godam and the accounting offer you, either you can go for LIFO method or FIFO method, or weighted average method, but you cannot have your own method of recording inventory. So here for the revenue recognition, it is same. Like either they can say you can go for the expected value method, or you can go for the most likely amount method. So both of the approaches are there. You have to mention in the financial report which method you are following. Next, is there any significant financing component available? So if there is any interest available, for example, you have a contract, you sell a bike, same bike, and the guy say, I cannot pay now. Can I pay you after a few months? Or maybe I will pay you after 1 year. What will happen to the interest that you will get on that bike selling? So interest will never be your revenue, and it should be recognized separately as interest income in your profit loss account. However, if there is income that will be inflow to you and it has a useful life for more than 1 year, then I like you to take back to the concept of IFRS 16, which is lease. In the lease, we're getting an interest, and interest is charged to the profit loss, whereas the present value of the future in cash flow we have to calculate. So there is a discounting factor which will come up, which discuss that if we are getting a cash in the future, we have to discount that for today, and then we have to recognize it as a revenue. So next, there is one question available. I'll leave this question to you because it's a lease question. So same lease question is given. They give you the interest rate. They give you the monthly installment. They tell you what is the amount. They prepare this lease schedule per month, per year. You are getting these cash flows. The interest rate is 12%, so it will be applied on this interest amounts. Every month you are getting a liability of this, which will deduct from 5,000 and remaining will be given here. So this is just a copy and paste from the lease chapter. It's a good read. Please do read this one. It's very important also to understand the application of IFRS 16 in IFRS 15. How are you going to recognize the income or revenue in this situation when the payments are for 5 year, 4 year, and it's a long-term payment where you are getting and you have to discount back to the present value. And these are the few entries which they mentioned. It's the same entries which we did in the lease, so there is nothing new in this one. Now, the last item is in the cash transaction is the non-cash consideration. For example, the revenue is measured in the fair value of whatever it is received. You make a contract with somebody that, hey, I'm selling you, okay, let's take this example. There's a company A who is providing a services to company B. Company B say, hey, we cannot pay you via cash. What we do, we give you a machine in return. The machine in our books has a cost of 75,000. It has accumulated depreciation of 20,000. The market value of that machine at that time is 60,000. So the question is that whether the revenue recognition will be done on the fair market value or the carrying amount. So the standard that say that whenever there is a transaction in kind, else than the cash. So what you need to do, you need to record that transaction in your books based on the fair market value. So solution is given. For example, this guy get a machine for his services, so he will debit the machine by 60,000 rather than 65,000 and record as a revenue, consultancy revenue. So normally there is a cash instead of a machine, but since this transaction is in kind, so we write machinery as a debit. Then the fourth step, so just to recall back, we have a 5 steps of revenue recognition. Contract identifying, number 1. Number 2, what you need to do, what is your performance. Number 3 was a transaction price. This is step number 4. Then once we determine what we need to do, what is a performance obligation and what is a transaction price, now we allocate this transaction price on the performance and obligation. Like if you have a step-by-step building, you're constructing a building and you have different stages on that. So those stages has to be allocated for which stage, how much money I will pay you. Normally that is done on percentage of the completion. You are getting cash on percentage of completion. For example, if the building is 90% complete, you will get the 90% of the payment. If the building is 60% complete, you will get 60% of the payment and so forth. So this is the basic idea that once you're done, how much money there will be there. Once you're done, what you need to do. And if it is a multi-stage or multi-performance obligation, then you need to allocate that money over the performance obligation. So now allocating a different price on that is, if it is just a single performance, is very easy. So we do one shot, we produce 100,000 t-shirts at one shot, we get the money, it's very easy. There's no such a thing like an allocation. However, when there is a more than one performance obligation, which I just discussed, like constructing an account, constructing a building, it will take some allocation. We have to decide at the start of the contract, if we complete this, how much money we will get. Now, there is a question based on this, this transaction. Now, let's read the question. This example, which is taken from your book, question number is 15.7. There's a company who sell van and also provide a national roadside service plan. The van can be sold for 40,000, and the roadside plan is 500 per annum. So what this guy do, he kind of give you a discount offer. They say, we will sell you the van at the rate of 38,000 along with a side road plan. So if we sell these together separately, like 40,000 for the van and 5,000 for the side road plan, it will be 40,500. Whereas he give you for 38,000. So he give you a discount of 2,500. So what you need to do, you need to allocate the transaction price of the contract to each of the separate performance obligation. So there's two obligations: providing you a van and giving a roadside service. So in these two different performance obligation, the price should be 40,000 and 5,000, whereas he give you for 38,000. So it means he give you a discount of 2,500. The first allocation is 40,000 divided by the total amount. The second is 500 divided by 40,500. So you kind of proportionate this discount into these two. The discount is same 2,500. So the discount allocation for the van is 2,469. For the road size is 31 US dollar. So amount allocated for this one, like you are getting for example, 40,000 from here, after the discount of 2,469, you are actually allocating amount of 37,531. Same goes with the service roads tax, which is a 500 US dollar price for service. He's giving 31 US dollar discount. So total he's actually getting 469 US dollar. So in total it is a 38,000 contract. So you actually divide the discount which is given in the lump sum. If you take a van, I will give the road service also, into these two different activities, and then you allocate the price accordingly. So if two services are given, which is entirely different, you need to also split the discount between these two to determine its price. So this is how the allocation of the transaction price is given to separate performance obligations. The last step, step number 5, is to recognition of revenue as each performance obligation is satisfied. So after you done everything, you decide what is the money, how much transaction cost will be allocated to each one. The last thing is, hey, I need to perform it and I will record that in my accounts. So they say you can record that in your accounts, but based on a very simple rule. The rule is that you need to satisfy the performance obligation or transfer the control to the buyer. So for example, I need to deliver you van and you are buying a van. So once I transfer you the key and the card and the transfer on your name is considered done. So revenue can be recognized at the time when there is a transfer of the control. And for example, I have leased you out the asset, and in this lease, by the end of the day, end of the lease period, it will be yours. So it's a financial lease. So in this case, once I transfer you the asset, although maybe you are not living in that building or some flat or something, but you just lease out that for 5 years. So even if you are not using it, but since you are paying the money for it, for have a control indirectly, it's also considered that the asset has been sold or the revenue can be recognized now. So there are 4 different conditions which they have mentioned in this slide, and then they talk about different indicators of the control. The goods and services are the assets which is momentarily given to from the seller to buyer. They have ability to directly use these assets. They have a control to prevent other entities to using it. They have the benefit of using, and there's a future cash flow which will flow towards the university. So this is a basic definition of having an asset, that there's an economic benefit which will get to the entity. So few of the indicators which you can consider is entity has a present right for the payment for the asset. The customer has a legal title. There's a contract signed, although the property has not been actually transferred. Or in case of a physical transfer, definitely yes. The customer has a significant risk and reward already been shifted to him, and the customer accept the asset. So once there is an offer and there is acceptance, it's considered that the ownership has been transferred from party A to party B. So these were the few indicators. Now we talk about the performance obligation satisfaction over the period of time. When the performance obligation are satisfied over the time, for example, under the construction, then what will be the different consequences of that? So this slide until the last is discussing about the accounting for the sales, which is associated with some conditions. And we will discuss that in the next video. So thank you. Thanks a lot for listening. I will come back to you in the next video.